Welcome back, guys. So, from where we left, we are starting off this topic record transactions in a general and post entry storage. First of all, in previous lecture, we identified the transactions or events and then we analyze those transactions. Now it's part to record the transactions in a journal and post entries to ledger. So we have to do two tasks now. First is recording transaction in general, then posting entries to the ledger. Okay. Then we will be going to make trial balance. Let's okay guys. So as I already told, identifying and analyzing, we have already did this that part. Now posting into the ledger and recording journal entry. First we will record journal entry, then we'll be posting it to the ledger. Now, if when we make general journal, okay, we need to keep few things in mind. The first is date. We have to mention the date. This date will help us in the transparency of the accounts, like when the transaction or event happened, how did it impacted our accounts. Secondly, account title and explanation. Account title, just like cash or capital or liability, anything you will be mentioning this in that account. PR, this is a reference number. Like reference number helps in finding the account heads, or like we have like sequence the account heads in different manner. So this reference it gives us about the identification of the account head. Debit and credit. This is the amount we will be debiting or crediting. So you have to maintain this procedure. You have to maintain this like format while recording any entry. Okay. T accounts are useful illustration, but balance column ledger accounts are used in practice. T accounts, as we have seen in previous video, where there is a debit column and a credit column, and above that there was a account head title. That was a T account. Now we will be looking at balance column ledger accounts. This is how general ledger looks like. Okay, date explanation. Explanation will include the account head name, debit amount, credit amount, and balance shows the end amount of debit or credit. Okay, uh, sorry, balance shows the difference of the debit and credit. So posting journal entries. Here you have been given arrows, which is showing like for date, this is like recording the entry. Date, we have taken the date from general ledger, okay, posting it in general journal, okay. Date, date came from the cash and capital accounted titles. The reference number also came from the general, okay. Debit and credit amount also came from there. It's not a like there were typical, we can see from here. Analyzing the impact of transaction accounts and financial statements. So first is like we have done right by now the first two steps. We are on the third step. Double entry accounting is useful in analyzing and processing transaction. And as each transaction follows these four steps. In accounting, in financial accounting, whenever any event occur, it is gonna impact more than one account heads. Okay. Why we call it double entry system or double entry accounting? Because if one account head is impacted on debit or credit side, the other account will be impacted on credit or debit side. Okay. Just like if I have paid the salaries to my employees, then this like event has two impacts. First is my cash is going out. my cash is decreasing. And whenever asset decreases, it goes on credit side. Okay. Second is I am paying salaries. So salaries is an expense. Salary is expense. Whenever expense increases, it goes on debit side. So this accounting equation is balanced. The amount by which assets are decreased, by that amount, the equity part has decreased. So the basic accounting equation will always remain same. That's what double entry do. So processing transactions, now coming to transaction, receive investment by owner. These are the examples like they have given. We are like Fast Forward receives $30,000 from Charles Taylor as an owner contribution. Now owner is contributing $30,000 in the business Fast Forward. Okay. So this is gonna increase the equity by 30,000. And whenever your equity part increases, it is gonna on credit side. Okay. Just see the third part. Taylor capital increase. So it is on credit side by 30,000. And similarly, that like the contribution of owner came to into your business as a asset. Cash is an asset. Okay. So whenever asset increases, it goes on debit side. So now the balance is zero. That's all like your double entry account system do. The accounting equation will always be balanced. Similarly, there are more examples. Let's go towards that. So here, Fast Forward pays $2,500 for cash supplies. Okay. So now see the analysis part. Analysis in analyze part, he's showing the impact of this entry through the accounting equation system. Cash decreased by 2,500 because Fast Forward is paying $2,500 for supplies in cash. Okay. Secondly, supplies is increasing by 2,500. Okay. So supplies is also an asset. Your asset increased. So one asset is decreasing, which is cash. Cash is decreasing by 2,500, and by the same amount, supplies is increasing. So overall net impact is zero. Okay. So I always say like accounting equation balance will always be equal on the both sides of the equation. Third is purchase equipment for cash. Fast forward pays 26,000 cash for equipment. So equipment increased by 26,000 and cash decreased by 26,000. And we can see like recording equipment increased 26,000. Asset, it's asset, it increased, so it's on debit side. Cash, it's an asset also. It decreased, so it's on credit side. Net balance is 0. Okay. Here you can see like cash is 2,500 credit. It is coming from the previous accounting entry. Okay. 2,500. So we are maintaining the T accounts as well. Again, supplies, purchases supplies of 7,100 of supplies on credit from supplier. Now we are buying supplies on credit. So this will increase our account payable account by 7,100. Accounts payable is a liability account. Whenever liability increases, it goes on credit side. Okay. And supplies is an asset, it goes on debit side. So from previous entries, we see that we bought $2,500 supplies on cash. So that number two, 2,500 is already there, and 7,100 came from this entry. And accounts payable, it we haven't had the account payable account before, but now we have bought something on credit. So 7,100 is on credit side. Provide services for cash. Okay. This is like again you can easily see, you can like now understand the equation. you can now analyze and record and see their effect on post. So we can keep going. Payment expense in cash again, thousand $1,000 cash is decreased. We have paid through cash. Rent expense, okay, it's an expense. Salaries expense and cash paid. So I am moving forward. You can see all these impact. All these transactions are being accumulated in their own respective T accounts. This is what all these slides are telling. Okay, you have to understand this. And then we will be seeing the whole cumulative effect of all these transactions. Now, 13 1, pay cash for future insurance coverage. Now, if I am paying for future insurance coverage, it will be giving me benefit in future economic benefit. You remember one thing? It's an asset. Okay? So it's prepaid insurance. It's 2,400. Prepaid insurance is your asset. It increased by 2,400 and cash decreased by 2,400. Again, at the T account ledger, we can see cash is decreased or credited by 2,400 and prepaid insurance new account head is bed, which is 2,400 on the debit side. Similarly, purchase supplies for cash, payment expense in cash, payment expense in cash. Now, debit and credit rules. These are all T accounts we just made in previous transactions. Okay. Now we can see the cash account head, account receivable, supplies. We have all the end balances. And from here, we can take the cash end balance, account receivables end balance, supplies end balance, and they all end balances to the trial balance. That's how it works. Okay. From entries, you make T accounts, and from T accounts, you take the end balances to the trial balance. Assume Tata began operations on January 1 and completed the following transactions during its first month of operations. Jamsetji invested $4,000 cash in the Tata company. Invested 4,000 cash in Tata company. Cash increased. Okay. Asset increased. Debit. Equity increased by $4,000. So equity also increased. When equity increases, it goes on credit side. So equation is balanced. Then we will be making the T account, showing two account heads, cash and equity. The company purchased $2,000 of equipment on credit. Okay. Now purchase the equipment. Equipment is an asset. Asset increases by 2,000 and we have bought it on credit. Okay. We have to pay for this in future. So it's account payable. We have liability to pay this $2,000 in future. So liability increases on credit, asset increases on debit. Equation balanced. Okay. The company provided 5,400 services for a client on credit. We have provided services. It means account receivable. We will be receiving for these services in the future. Revenue increased. When revenue increases, it goes on credit side. Okay. For each transaction, analyze the transaction using account equation. So you can do this for your own exercise. I hope you guys can easily do this part as we discussed. Okay. This all is discussed. I have discussed all this. Moving forward. Okay. Now, guys, we will be discussing and explaining the trial balance. We will learn to how to prepare and explain the use of trial balance in the next video. If you have any query, if you have any question, you can directly email me or drop your question or query in comment section. I will be soon back to you as much as possible. Okay. See you guys. Take care.